Um, did you click on a broadcast option?
I didn't see that.
Okay.
Do you want to start all over again?
No, it's okay.
Okay.
Yeah, so please just start sharing your screen right now.
There we go.
Okay, cool. Is there a beginning of the presentation that allows you to like go?
That allows me to what?
That's just like the beginning of the presentation. Like there should be some slides that talk about Central Valley Scholars and like the organization.
Mm-hmm.
Okay, cool. Could you just start from like the very first slide?
All right. So can you see that? That's the main one. Do you want me to just start there?
Yeah, just start
About
from the
us?
just start from the very first one that you
Okay.
that's on there.
All right.
Okay, cool. I'm going to. Okay, we have one attendee in here. Okay, cool. Is the About Us slide the only one that's on there about Central Valley Scholars?
No, so we have the MoneyWise. We have. Can you see that screen or can you not?
I can see it. Yeah.
Okay. So we have MoneyWise, the intro, and then we have About Us, which is the Central Valley Scholars. And then we have Upcoming Services, Central Valley Scholars. And then we have Land Acknowledgement.
Okay.
We
Is
have the
About
intro.
Us About Us the first one that talks about Central Valley Scholars?
Yeah.
Okay, cool. Just keep it on that one then.
Okay.
Okay, awesome. Okay, so let's see, what time is it? It is 4:04. We're gonna wait about a minute for folks to hop on, to come in. Okay.
All right, so you're going to start with the About Us, right? And then
Yeah.
we'll go to the next one and you'll do that one, right? Slide 3, slide 4,
Mm-hmm.
and then into my intro?
Yeah.
Okay.
Yeah, don't worry. I'll tell you when to change the slides.
All right. So we have, right.
Okay, we're gonna give it another minute.
I am so sorry about that. I was waiting on the wrong one for like ever.
No, it's okay. It seems like very confusing sometimes. I get it. Okay, it is 4:05. So we're gonna start.
Okay.
Okay, cool. So let me just look up. Okay, cool. Hi everybody. Thank you for joining this webinar today. My name is Dominic. My pronouns are he and his, and I am currently the events coordinator at Central Valley Scholars. And so here at Central Valley Scholars, we introduce ourselves with our pronouns to normalize that practice and hopefully create a safer space for our hosts and attendees by respecting their gender. Okay, and so the About Us. All right, so I'm going to first talk a little bit about what Central Valley Scholars is if you aren't familiar. So Central Valley Scholars is a nonprofit, nonpartisan organization composed predominantly of youth and young adults organizing across the Central Valley. Our mission is to serve, not save fellow students from the Central Valley by creating resources such as this webinar. We also give out annual scholarships, have 2 mentorship programs to give a select number of students one-on-one help with the college application process. And we are currently developing an ambassadors program to help spread the word about our events and like different things that's going on within our org. And as part of our financial literacy series, we will also be hosting a FAFSA webinar next Saturday, October 17th from 4 to 5 p.m. in conjunction with UC Berkeley's Financial Aid Office. And so the following Saturday, October 24th from 4 to 5 p.m., we will be having the California Dream Act webinar co-hosted by Central Valley Scholars board member Myra Nunez and Central Valley Scholars marketing co-director Diana Salinas. So please look out for that and make sure to spread the word and RSVP as soon as possible at www.centralvalleyscholars.org/workshops. And I will paste this into the chat right now. Okay, cool. Okay, can we move on to the next website? The next slide, please.
Sorry. Yeah.
Okay, and for the most up-to-date information, make sure to visit our website at www.centralvalleyscholars.org and sign up for our newsletter. This way you can stay informed on any workshops, any programs, or anything that's going on within our organization, and you can get involved. Can we move on to the next slide, please? Okay, so thank you all for being here with us today. Now I'm going to lead us into a land acknowledgement to ground us in the work we are doing today by acknowledging the history of the land we're on. So I know we're all in different places today, but I'm currently in Fresno, which is Yokut's territory, as is much of the Central Valley. And so I want to take a moment to acknowledge where we are, and that the earth below our homes and below our feet is indigenous territory and has belonged to and been tended to by indigenous people for hundreds of thousands of years. When white settlers arrived to what we otherwise know as the United States, they enacted genocide and theft at the land, labor, and resources, attempting to wipe out indigenous communities entirely. It is important to acknowledge the land we are living on and to recognize our history and relationship on the ongoing legacy of colonization in the US, and to also recognize that the indigenous people are still here and their resistance and resilience are still on the front line struggling for land rights, collective liberation, and an end to white supremacy. I invite you to take a moment to think about your relationship to this land and its history. Let's let those who have come before us in the struggle inform us on where we are going so that together we can reimagine and collectively build a world where we are all free. And so I'm going to drop a link in the chat right now where you can enter your location and find out which indigenous territory you are on in case that's something that you're interested in. I am going to also drop a link for some additional resources right now. Okay. Okay. There you go. I highly encourage you all to check that out in case you're not really familiar with land acknowledgements or what they are and the meaning of them. Okay, awesome. And now I am going to pass it over to Noemi, who will be leading us into our presentation today.
Awesome. Thank you, Dominic. Today we're here to do a money-wise presentation, and it's basically about budgeting. So we're going to be learning a little bit about finances, personal budgeting. My name is Noemi Valenzuela. I am with EECU, Educational Employees Credit Union. My pronouns are she, her, hers. I am Community Relations Officer again with EECU, and this is my main focus, is financial literacy. So we're going to jump right in. Our goals of this presentation is financial goals, importance of saving, budgeting, credit, balancing your account, and a lot of in-betweens. So the first thing, jumping right in, when you're dealing with finances, it's the same thing as dealing with life, right? With academics, you have to set goals. You have to have the goals. Second, you have to make a plan, right? So what steps are you going to take to get there? And finally, you have to make it happen. So a lot of us set goals, we get to making a plan, but we never actually make it happen. And this is very important, not only in your personal life, but also in finances. Okay, we've got to take that steps and actually do it. So there's 3 types of goals: short-term, medium-term, and long-term. Again, just like your academics, just like your personal life. So we'll go into the short-term. So this is a goal within the next 6 months, right? So financially, you can think about this for a minute, and what would be something that you would buy or save for within the next 6 months? Right? In the financing world, we refer to it as budgeting. So again, within the next 6 months, a budgeting would be monthly bills, gas, rent, or mortgage. So again, these are our monthly bills. Okay, think about like your cell phone bill. These have to be paid for, because if we don't pay for them, we're going to get cut off. Right? So again, short-term budgeting. So the next one, medium-term goal, within the next 12 months to 5 years. Right? In the financing world, this is saving. This is the most important important goal that exists in budgeting and financing. So within the next 12 months to 5 years, right? What are some things you would save for? And just think about that, just internally, and what would it be? A lot of people would buy, would try to save, especially for seniors or high school seniors going into college, or maybe even college students, saving up for a car, right? That doesn't happen from one day to the next. It's it can take time. So again, 12 months to 5 years, these are some of the things that you would save for, medium-term goal. The third one is long-term. So this is more than 5 years from now. And I know it seems like a long way away, but these are things we have to think about. Long-term in the financing world is investing in your future, right? Some of those are 401k, retirement. When you get to that point, when you have finally gotten your degree, or even if you found a job, right? These are questions you have to ask. What's in it for me? I'm sorry, I went ahead of myself. What's in it for me, right? You have to ask if they have a retirement plan. If your company or organization, whoever you work for, do you have a retirement plan? And what that is they'll take a certain amount of money out of your paycheck all the time you get paid. This money goes into a savings account per se, right? And you don't have access to this account or very limited access. And what happens is when you're ready to retire, you can pull that money out, right? That money is now yours, and they can give it to you on a monthly basis, just as like as if it were a paycheck. So again, we have to ask these questions, and we have to make sure we start building our finances and setting that healthy base for ourselves. All right. So the first thing you think about is pay yourself first, and we have SpongeBob here dancing, right? I talk about saving. It's exactly that, paying yourself. You know, even if it's just a little bit. I know a lot of times, even if you don't have a job, if you have, you know, maybe just financial aid or maybe you have grants, but this is money you have to put away. And I'm not asking you to put away all of it. I'm not asking you to put half of it, just even if it's $5, $10, just to start, just to get into that habit of paying yourself first. Again, putting it into a savings account. So why is it important to save? Right? We always talk about this, but why? Why is it important? Why though? Right? We have Baby Yoda there asking. So the reason is because we can't predict the future, right? There's things that happen all the time, and we're in a perfect. I won't say perfect situation, but a perfect example. This pandemic, nobody saw this coming, right? A lots of people have been laid off from their jobs and have lost their jobs, right, because of what's going on. And the thing is that because of stuff like this, because we can't predict it, we have to save something. We have to have some type of cushion put away. That way it'll get us by when stuff like this happens. Other examples are car repairs, right? Those in firsthand, right? Those can get expensive, very expensive. Um, Disasters, right? There is fires. You know, there's been fires all year, last year, this year. So these are things that happen. There's also home repairs, and there's many, many others, right? Stuff we can't predict that happens, but we have to have something put away just to cover ourselves. Another reason it's so important to save is financial security. Okay? We all want to be able to go out through life, be able to have that cushion, say, hey, you know what? If something happens, I'm okay. I'm comfortable. It's okay. I can get by. Another thing is it helps avoid financial stress and burdens. Right? The number one reason people are getting divorced in the United States is finances. Okay. So again, try to avoid that stress and build that financial stability for yourself by putting something away. So next one is spending leaks. And this is pretty interesting. On here on the screen, I have Starbucks and I have Taco Bell, so fast food. So what happens here is spending leaks are when you go to the cash register, right, and you pay for something that doesn't seem like a lot of money. And here's a perfect example: the Starbucks. Let's say you go to Starbucks, you get $5 coffee. I know it's a little more, but just for math purposes, right? When you go and pay, it doesn't seem like too much, right? $5, it's okay. I can handle that. Okay. But a spending leak is when you do it over and over and over and it starts to add up, right? So again, we'll give Starbucks as an example, a coffee. So if I were to go to Starbucks every day for 1 week, $5 a day, that's about $35, right? If I boost that up, go every day for 1 month, that's going to add up to about $180. Right? And if you bump it up to a year every day, and there's people who do this, and that's fine, but you have to make sure you budget for it. But if you go for a year, it's going to come out to about $1,000. Okay? In my household, that's not going to fly, right? This that can be for a mortgage, right? That can down payment for a car, right? So these are things that we have to be aware of. Also, I placed the logo, the Taco Bell, perfect example, and I do this because I was working with a student. Um, And what happened was he had budgeted, he was set, he went off to college, had all this in place, had this money saved, and all of a sudden he started running out of money and he couldn't figure out why. And he had a spending leak and it was Taco Bell, right? So, when you go to Taco Bell, it doesn't seem like a lot, right? You can get dollar menu, you're good. But the thing is that he was going constantly, right? And there was times that he would go twice in one day just because it was more convenient because at the time he was on campus and it was close. So it added up, right? So he had that spending leak and this is where he was losing his money, right? So these are things to be aware of, spending leaks. So brings me up to the next point is track and record your income and expenses. All right. This is one of the most important things, especially when you're beginning your budgeting or your finances, your own finances. You have to know where your money is going, what's coming in and what's going out, and you have to record it. Right. And let's go into detail on what that consists of. So you have to build a spending plan. All right. So how much am I making? How much do I have of income? And how much is going out, right? So the first example is the first bullet point is envelope method, right? So an envelope method, the theory is that every bill you have for the month, every bill, okay, everything you have to pay, you're going to write it on an envelope, right? So here, the first example is savings, because of course we pay ourselves first, we have to put something away, right? The next one is rent. The next one is utilities because you need light and gas, you need water, right, to be able to live. And then you have a car loan. If you have a car loan, if you're making some type of payment for your car, it would go in here. Gas, because we need gas to get around, right, if we're going to have a car. Second one is groceries. Again, we need to eat, right? So you have to budget for it. Another one is cell phone, right? And the last one, I have school or books, etc., because we know there's always expenses related to college or to schooling. So again, the idea is that the sum of the money in these envelopes is going to equal your monthly expenses, right? So at the beginning of the month or whenever you get paid the first time of the month, um, you're going to put half of what your bill is into this envelope. And every time you get paid, you start to put the money in the envelopes, okay? So the idea is at the end of the month, you will have you will have saved enough money to be able to pay the bill completely. Right? So that's the idea. That's an envelope method. The second one is receipt method, right? So all the time you go to the store, you get a receipt. At the end of the day, do your math. How much did I spend? Did I go over budget? Did I go under budget? Did I need to spend that money? Right? And it makes you aware of what you're spending on. The next one is Excel or Google Sheets. So this is a little more tedious, but it works for some people. So what you do is everything that you've spent on, you put it into the Excel or Google Sheets. Every bill that you have during the month, you put it into the document, right? So it does the math for you. So how much how much is going out? How much do I have to pay for bills this month? And how much is coming in? How much is my paycheck? Or how much am I going to get paid completely this month, right? The next one is the notebook, right? And personally, this is what I do. Old school. I just write it down in a notebook. These are my monthly bills. This month I may have to be spending on this, on certain things, right? Certain items. So I put this down in a notebook. And then I have written down how much I get a month, right? How much my paycheck is a month. And I start to do the math, right? And so I need to make sure that I'm going to have enough for the month, okay? I need to make sure all my bills are paid and I'm going to be okay, right? Others are apps, right, that do all the work for you. But you need to make sure also that you're checking these and make sure that the math is right, right? Because sometimes it happens. So there's Mint, there's Expensify, there's a note section in the iPhone app or the Notes app in the iPhone that that has a budgeting section, or you can do this. Another one is EECU app. Okay, any financial institution, credit union, bank should have an app that you can use that'll do the math for you. But again, we need to constantly be checking these. And some of these, and let me go back, as far as the apps, some apps, if you do a search, they may cost you, okay? And if they cost you, I suggest you look for something else because there's very good apps that'll do the job for free, right? And that'll save you a little bit of money. Also, everybody has their own methods. You have to find what works for you and test it out. See if the envelope method works for you, the receipt method, just test it out, whatever you feel comfortable with. So the most important math equation you'll ever learn, right, in budgeting, financing, what you earn minus what you spend. Okay, so what you earn is what's coming in. Okay, what you spend is what's going out. So again, you earn, okay, your income, what you earn is your income. There can be allowance, there can be paychecks if you have a job, financial aid, which is the scholarships and grants, right? The free money. It can be work study. Okay, all this is money that's coming in. What you spend, that's money that's going out. Okay, so think about some of the things that you spent money on today, right? I haven't been out today, so that's pretty good. I've been pretty good today. I haven't spent any money, right? But these are things we need to think about. So spending. Um, so the next one, what happens when you're earning more than what you're spending? Right? This is good, right? This is where we want to be. There's more money coming in than there's money going out. So that's keeping us in the green. We're keeping a balance. Okay? This is the goal in financing and budgeting. So what happens if you're spending more than what you're earning, right? This is when you're going to get in trouble because there's more money coming out of your account than there is coming in, okay? And that's when you get into the negatives. And that's why this is red. This is something we want to stay away from because this is what causes issues, what causes problems, and it's very challenging, all right? And one of those reasons is for non-sufficient funds, okay? Which equals more fees. So what happens? And that means like if you're overdrawn in your account, that's pretty much what it is, right? So when you're overdrawn, your financial institution is going to charge you. So on top of the fact that you were barely making it, that you barely had enough money, now on top of that, you have to pay back your financial institution because you're not keeping record of your account and you're not balancing. Um, the thing with this also non-sufficient funds is that it gets you into trouble, right? So let's put an example. You found some, you have your account. You think you have about $20. You're not sure, but okay. You go to the store, okay? You found some jeans that you liked, right? And these jeans were about uh, $25, right? So again, you go to the register. Okay, I'm going to pay for them. I'm going to go buy them. If I have enough money, it goes through. It goes through, right? If not, well, I'll just put them back. Okay. So what happens here is, yes, you paid for your jeans, which are $25. Okay, but you only had $20 in your account. So your financial institution says, all right, well, you didn't have enough money in your account, but it's okay. We'll cover you. Okay. But on top of that, I'm going to charge you $35. Okay, so when you do the math, you spent way more than what you were supposed to. Okay, you spent way more on the jeans because aside from the fact that they were $25, you now have to pay $35 back to the bank. Okay, and this fee can vary from financial institution to from different financial institutions. So again, the idea is non-sufficient funds, overdrawn fees. This is what gets expensive, and people do this over and over, and it's so hard to get out of. You're digging a hole for yourself. And there's a cap to how many times you can do this depending on your financial institution. So the golden rule, don't spend more than what you earn, right? And repeat that, okay? Repeat that to yourself. Don't spend more than what you earn. I know it sounds simple, and I know it's difficult, right? Because life happens. And that's why we need to just take the steps ahead of time when we have the opportunity, put some money away. Again, put it into a savings account, cover yourself, have that cushion for yourself because life happens. We talked about it, I touched on that earlier. But again, don't spend more than what you earn. If you just stay in that with that idea in mind, it'll get you it'll get you far. It'll be so much easier. So things to consider. Having said that, right? Things change in your life, you may have a new job, you're going off to college, maybe you're living in a new city. Um, you need to update your plan, right? So it's always important to update this plan. And it could be the opposite. You may be, you have a new job, you may be getting paid more, which is the goal. Or other times it may happen that you're getting paid less and you need to adjust, right? And this is a little tidbit too, is kind of like your lifestyle, right? You need to know what you can afford and what you can't. All of us want the nice cars, the nice clothes, but realistically, you look within your budget. It's like, can I really afford that? Am I going to go into debt just because I want something that I can't afford? These are things that we need to ask ourselves. So again, as things change in your life, you should update your plan. So with that said, I mentioned going off to college, maybe living in the different city, but EECU just launched this website about a year ago, this page on our website. So what it is a college cost and compare calculator. So if you're considering going to a different city to go to college, or just considering different colleges, this is perfect, right? So you select your household income. It can be your parents' income, more or less. Doesn't have to be exact. How much are they? How much are they according to their taxes? How much are they getting? Select the resident state. Okay, so for most of us, it'd be here in California. And then you search for colleges, right? And it can be anywhere in the nation. So you can compare it, right? And it'll tell you more or less how much financial aid will probably cover and how much you have to come up with. And this is a starting point for you, right? To budget. One thing though, I want you to consider is, I know when you do this calculation, it seems like a lot of money that you're going to have to pay, that you have to come up with for college. But we need to remember, there's grants, there's lots of scholarships, there's student loans. There's always a way to pay for this. And no matter what your status is as a student, there are lots of avenues that you can reach out to that'll help you pay for school, right? And that brings me to the next one. On our website as well, we have local scholarships, right? On this on this document, it's also on our website. There's 50 scholarships that students can apply to. Okay, so this is when we do our homework. Okay, what can I do? What scholarships can I get? What can I apply for? What requirements do they have? What's the due date? Right, this is when we have to be diligent and start doing these just to help ourselves. So other budgeting essentials. Okay, so other financial important financial information that you should know. So credit unions and banks. There's three major differences, all right? And I'll just briefly touch on them. So credit unions and banks. Credit unions are not for profit. Banks are for profit. Another thing is that credit unions, the money that is we'll say the people who have accounts with credit unions, right? The money that they put into their accounts, that money's like recycled, okay? Quote unquote recycled. So what's that mean? It's given back to the people. So that means there's you have I'm sorry, you have like NSF fees, right? Non-sufficient fund fees that we talked about earlier. They're usually lower at credit unions. The fee to open an account is usually lower. With EECU, it's only $5, depending on you can have a voucher, so it's ultimately it could be free. Another thing too is banks. It's a little different, right? They have stockholders which sit at the top, and they're looking to see where they're going to make more money, right? So the way they're going to make more money is people who have accounts with them. So your fees are going to be higher. Sometimes to open an account, you have a monthly fee, or just to open the account, you have to put a lot more down into your account, to keep in your account. But again, and interest rates may be higher. So again, these are things to consider. The third one is that something to consider too is, for example, if I have a certain bank, we'll say Bank of America, I have an account with them and I go to a Wells Fargo ATM machine. So aside from the fact that Bank of America is going to charge me for having to gone to another bank's ATM, Wells Fargo is also going to charge me for having used their ATM and not having an account with them. Okay, so these fees can build up, and sometimes they can get pretty pricey. Right. On the other hand, credit unions, many years ago, they came together and they created what's called a cooperation. So if you have an account with EECU, you use your ATM card or your card, and you go to another credit union's, we'll say like Golden One, you use their ATM, you will not be charged, right? Because they're part of this cooperation. They're trying to help people. So again, things to consider. And I'm not saying a credit union is what you should go for, a bank is what you should go for. I say this because this is when we need to be diligent. We need to do our homework. What is more convenient for us, right? So next one, checking versus savings account. All right, so a checking account is for your daily expenses, and you can see some differences here. A savings account is for that. It's to save, right? So when you start using your savings account as a checking account, you can say, so if you start making a lot of transactions, start taking money out more often than you should, this can also get you in trouble, right? So depending on your financial institution, they can say, hey, you need to calm down a little. You're using this savings account a little too much. It's meant for saving, right? And eventually, if you keep on doing it, they can close your account, right? Or put restrictions on it. So again, ATM access, with both the checking and savings account, a debit card, which is what we use when we make purchases at the store, that's linked to your checking account, not to your savings. Okay, a savings account earns interest. That means you're making money off of your own money, and it may be little, very little, but any little bit counts, right? And both the checking account and the savings account are insured within the United States. So this brings me to debit card versus credit card. Your debit card, again, is for your daily expenses. It's linked to your checking account, right? A debit card doesn't build credit. A debit card, you pay in real time. So the minute you make that purchase, that same day, it's going to take it out of your account, okay? With the debit card, you don't pay interest. With the credit card, it's a little different, all right? So it's almost like a loan on a card, right? If you want to look at it that way, it's more simplified. So a credit card helps you build credit, right? A credit card you can purchase now. You can make a purchase now with that credit card, but you don't have to pay it till later, right? With the credit card, most likely you will pay interest on it, right? And this is what on a personal, when I went off to college, this is where I got myself in trouble. I didn't know the differences, right? I saw a credit card as free money. It's not free money. You need to pay a credit card back. It's a loan that you need to pay back. And when you don't pay back or you misuse your credit card, you can get into a lot of trouble. Okay. And what do I mean by that? It's linked to your credit score. Okay. So a credit score is like your adult GPA. The higher your credit score, the better, right? So if you have a high GPA, you're going to have lots of choices as to where you can go to school or what school will let you in, right? Or will accept you. If you have a low credit score, it's going to get you in trouble, right? It's going to be a little more difficult, like to get loans. Also, sometimes when you apply for jobs, right? Sometimes they do this background check, and in the background check, they'll check your credit score. So if you come in with a high credit score, with this other, if you come in with a degree, this other person comes in with the same degree, you have the high credit score, they have the low credit score, the person they're going to choose most likely is going to be you. So this is something we need to consider. This is why we need to be responsible, not only with our finances, but also with our when we start to look at credit cards. There's one more thing I was going to say and I can't remember what it was, but I'll go to the next slide. Credit report, okay? It equals an adult transcript, right? So everything that you have, like loans that you've taken out, credit cards, if you paid some loans late or some bills late, it'll be on your credit report, okay? So credit report is what financial institutions will look at when you're looking for a loan, a car loan, a home loan. Even if you're trying to open an account with to get a cell phone, they will check your credit report. Okay. Also with utilities, PG&E, they will check your credit report. So it's very important to keep your credit and your credit report clean. So again, like an adult transcript, every class you've taken is going to be on the transcript. Same thing with your credit report. Every loan you've taken out, or if you haven't been responsible, it's going to be on the credit report. So remember the golden rule. Don't spend more than what you earn, right? Don't spend more than what you earn, because then you get yourself into trouble. And I'm going to go back a little bit here on the credit report. One thing that I didn't place on the slide, but I want to mention is it's important to check your credit report and even share it with your family. The reason for this is because there's lots of fraud, especially right now in the situation that we're in with the pandemic. There's identity theft, right? There's lots of things that can happen. So it's important to check your credit report and make sure that everything that's on there actually belongs to you. And another reason to check it, is you need to know what's on there. You need to make sure that you're aware of what's on there. And if there's something that's on there like, oh crap, I need to fix that, then you need to like take the steps now to do that. Okay. So that's why it's important to check your credit report. So again, the golden rule, don't spend more than what you earn, right? So do we have any questions? Dominic, I can't see the chat, but maybe you can let me know if there's any questions.
Yeah, of course.
Yeah.
So we do have two questions. So the first question is, what advice do you have for a full-time student who has credit card debt? What steps should we take if we already have debt?
Okay. So first thing is, I say go to your financial institution, or even if you're already on, if you're getting letters about your credit cards that are not being paid, reach out to them. They will work with you, right? Because the last thing you want to do is sit on them and just let them sit there and just accumulate. Because when you take that step to call them and say, hey, I can't make big payments, but who knows? They'll work with you, and maybe you can work something out as something that's affordable for you to pay that credit card back, because it's going to affect you, and it's really hard. Um, it's really hard to clean your credit after that if it starts to build up.
All right, our next question is, how can you protect yourself from identity theft?
Be diligent. Um, be diligent. We have a whole nother presentation on that one, but um, I would say just be very careful. A common one is putting your information on when you're paying for something online. Make sure it's secure. Make sure that website is secure. Always check your accounts. This is why I said this earlier. When you monitor, when you're balancing your account, you're looking to see if there's, everything that's on your account summary with your bank or credit union. You got to make sure all that is yours, because if it's not, that's your first step to really looking into if you have fraud in your account. Okay, and the quicker you get it done, the quicker you catch it, the better, because it doesn't seem like a lot, but that's how they start usually. They'll try to take like $5 out of your account, $5 here, $5 there. It doesn't seem like a lot, so people just, oh, it's $5, I must have spent that somewhere. But that's not always the case. They're just testing it to see when they can ultimately take more out of your account. So again, be diligent with your account. Check your account daily.
Our next question is, what are the advantages of credit unions and what are the advantages of a bank? How do you know which one is the best for you?
So I think it's just your comfort level, your convenience. Um, Credit unions are usually, and not because I work with the credit union, but credit unions are usually a little, their fees are a little cheaper than a normal bank. The thing with the credit union, though, this is the downfall, right? Or downfall, quote unquote, is that not the credit unions are a little smaller. So you don't have one on every corner like you would a Bank of America, or a bigger bank. Um, Again, on the other hand, the bank, it's more, it's convenient. Like, again, you can see them on every corner. But also to remember is that credit unions, again, they work together with the co-op, so you can make a deposit at another ATM that belongs to another credit union, and you'll be fine. So it's your personal, I think, whatever is convenient for you.
Okay, and our next question is, what does it mean when savings account earns interest?
So, just in simplified terms, it just means that you're gaining money off of your own money. So the longer your money stays in there, the better, right? Because then you're building interest. The more money you have in there, the interest you're getting paid is going to be higher. And this can vary also from bank to bank. Um, but that ultimately, that's what it is. You're just gaining money off of your own money, and it can be cents. And usually that's what it is. So if you have that, we'll say you have $100 in your account, or more than $500 in your account, then you start to accumulate more money on it, gain money off of it. Did that answer?
Uh,
Was that okay?
Next question. Yeah, that was a great answer. That was a
All
great
right.
answer. Um, so our next question is, what are some other ways to build credit?
Some other ways to build credit. So this is another tip we give to students, right? One, you have to be aware of what credit cards you open. So I'm going into a whole another presentation here, but one, you have to be aware of your credit card, right? You make sure you don't have extra fees on there, because if you have extra fees, it's going to take you longer to pay it off. So our suggestion is, when you make a purchase, if it's in your hands to do so, if it's in your budget, if you put something on your credit card, pay it right away. Okay, don't just make the minimum payment. Pay more than that, or pay the whole thing. If you can pay the whole thing, better. But when you let it sit in your account and you only make the minimum payment, that's when it starts to accumulate, right? So you're not only do you have to pay that back, but you're getting charged interest all the time it's not paid. So My tip is to use it and pay it off right away. A lot of students too, what we tell them is um, do your, like when you pay for gas, put it on your credit card and right away transfer it from your checking account and pay it, pay your credit, pay what you just charged on your credit card. And I have a few more slides too. Um,
Okay, so then
all right.
we'll save these questions for the end. So
Okay.
go ahead and continue.
All right. Awesome. Okay. So we talked about balancing your accounts, right? And here we're going to go on how to balance a checkbook. I know this is old school. I know people don't probably, for the most part, don't carry checks anymore, personal checks. They don't write it down, right? And we talked about this. You can do it. You can now do it in your apps. You can do it on, on your own in a notebook. But I'm sharing this because I want you to be aware of what the background is, right? What you need to do. This is how you balance your own account. So check register example. So this is what you would do to balance your account. This is the math that you would do. So again, in a check register, you have the date, right? So, and I'm just going to go through the columns. Next, you have the transaction description, right? So the transaction description is the way you code your expense. So if I have a cell phone bill, personally, I would put in the transaction description, I would just put cell bill. All right. If you have a car loan, okay, in your transaction description, you would put that car loan, right? So it's just to describe what the expense is. The next column, the red column, is payment fee or withdrawal, right? So this is how much that bill is. So for example, the car loan, okay, say your car loan is $300. It comes out of your account. Whatever comes out of your account is in this column. The next one is the deposit column, the green column. So this is money coming in, right? And then you have your balance. This is what you're left with, right? This is what you have to work with for the rest of the month. So again, you have the minus, the plus, and the equals, right? The payment fee is the minus, the deposit or the credit is the plus, that's money coming in, and then the balance. What's it equal out to? What do you have left? And we'll go through an example here. So the date, we have February, I know it's a while, we have February 18th, right? So that's the day that we paid this bill. Or okay, we'll do paycheck, right? So February 18th, you got paid, okay? Your paycheck came into your account. Okay, so we placed it in the deposit column, the green column, because it's money coming in, right? So your paycheck is $3,272, and so that's your balance. Because nothing else has come in or gone out of your account, that's what we're left with, is the balance. So 3,272 is what we have to work with. The next one, again, you put the date, right? The date that's gonna happen, the transaction will happen. So savings, we talked about paying yourself first, right? How much are you going to pay yourself? And you would put it in the payment fee withdrawal, right, column. So money coming out. And a lot of people ask, well, why are we putting it in this column? Why are we taking it out of our account if we're paying ourselves? The idea is that you're taking it out of your checking account and putting it into your savings account, right? So minusing from your checking account, adding to your savings account. So that's why it's in this column in particular. So next, what you do is you get your balance, which was 3,272, right? Now we're going to minus 100 from it because we took money out, okay? And what's that leave you with? So 3,272 minus 100, you're left with 3,172. So that's your new balance. So again, and this is repetitive, you put your date, right? The date that you made the transaction. So student loans, right? I'm still paying those. So your student loan, again, money that comes out of your account. These are bills that you have to pay. Okay, here it's $180. So again, you take it out of your account, goes in the fee column, the red column, and then we minus it from our balance. So 3,172 minus 180, and we're left with 2,992. And let me, just a little tidbit, right? So student loan, this is more information that was on the slide, but be aware that your student loans are federal loans, right? Or so if you don't pay those back, there's more trouble than your credit cards. Okay, we should be paying all of them back, but this will hurt you. Not only not only is it federal, but the thing is that if you don't pay it off, they're going to go after someone who can pay it, right? And most likely, for a lot of students, maybe their parents co-signed or maybe someone that helped them out co-signed. So they're going to go back to those people and they're going to say, hey, you need to pay this bill. So you don't want to put anyone in that weird situation. So just make sure you pay your student loans. Another thing too is that it's hard. You hear a lot of students, and a lot of times we do these presentations like, oh yeah, I had a student loan, so I wanted to go to grad school, but I couldn't because I stopped paying my student loan, so now I can't even apply, right? So I won't go into details on those, but it's always important to pay your student loan as soon as you have the opportunity to. So next one, the date, going on to the next one, right? February 18th again, so the date that they came out of your account. So this time we have the rent. Okay, so these are our monthly expenses. How much is your rent? Your rent is $900. So again, it's in the fee column, the red column. All right, so now we do the math. So we minus the 900 from what was your balance, 2,992. And what are we left with? Right? So we minus the 900 from 2,992, we're left with $2,092. And this is what you do over and over. This one's a little different, okay? So we'll say, again, February 18th, you received a birthday gift, right? It was cash. Um, it was cash from your grandmother, right? Or a family member, okay? And you got $250, right? I don't think that's gonna fly in my family. They'd be like, no. But we put it in the deposit column, right? Because this was money given to you. So ideally, the minute you get that money, you put it into your account. So we're adding it, we're depositing it. So in this instance, what we would do is we would add it to our balance. So 2,092 plus 250, what are we left with? $2,342. Right? So again, that's the last one I have. But again, it's just, it's repetitive, right? But this is what we do. This is how we do the math. This is how we balance our account. And usually this is what the apps do. And like I mentioned, Google or Excel, it'll do the math for you. But this is what's happening in the background. All right, so I've reached the end of my presentation. But before I close off, I just want to go back to those questions that we had talked about earlier, Dominic, and hopefully I can answer all your questions.
Yeah, of course. Thank you for that presentation, Noemi. It was great. I learned a lot of things too. So I don't know much about banking myself, so I was able to learn a lot. So thank you.
That's awesome.
Okay, so one question that we have is, what determines your credit score?
What determines your credit score? So I'll be honest. I'm just gonna be honest here. I don't know what the math is, how they actually give you the score. But I can tell you what affects it. What determines it is like if you pay your bills on time, right? How much, again, this is another presentation, but how much do you owe compared to how much you make, right? How many open credit cards do you have? How many big loans do you have? Do you own a house? Do you own a car? And things like this. This has a lot. There's certain percentages in each category that works together in determining your credit score. I hope that answered the question, or that was clear enough.
Okay, yeah, thank you. Next question is there no way to fix your credit score once it's bad?
No, there is a way. There is a way. It's just, you have to just take that step. You have to start, you first, I would, let me back up. So I would contact the financial institution, right? Like for instance, our credit union, EECU, we have a person that'll help you with your personal finances. So if you've gotten yourself into too much debt, you're like, okay, I don't know what to do from here. You can go to this person and there's no charge, right? So, and they'll help you out. They'll help you straighten out all your finances, and make sure that you start making payments to those credit cards that you're in debt with. But no, there is a way to fix it. And I'm not going to lie, sometimes it takes a little longer. It's quicker to ruin your credit than it is to fix it, but it's doable. You just have to take that step. And again, I would go to your financial institution if you have a bank account now and ask them if they can help you. Because a lot of times if you look outside of your financial institution, sometimes they'll charge you. Sometimes the financial institution will charge you too, but because if you have an account with them, it may be a little lower. So that's another thing to look out for too. But yes, it's doable.
Okay, can a savings account lose its value due to inflation or inflation?
Yes and no. So it just, I have to tread very lightly with this question, but you have to be careful, right? You just have to be aware of the interest rates, because interest rates will go up, interest rates will go down. So, and that's kind of linked to inflation at times, but it's all dependent on your financial institution. Those are questions you need to ask when you open your account, but most likely no.
Do you know where you can receive free financial consulting for personal finances?
EECU has one.
Okay, awesome. Yeah, so for that last question, feel free to reach out to Noemi for additional information on that. But those are all of the questions that we have. Thank you for this presentation, Noemi. If there are any more questions, please type them into the Q&A box, and Noemi can answer them for you. But if there are no more questions, folks are free to go, you're free to leave. Again, thank you for joining Noemi's presentation today. To stay up to date on future webinars or presentations like this, visit www.centralvalleyscholars.org. Yeah, so if there are no other questions, feel free to hop out and enjoy the rest of your weekend, folks.
Yeah, and also just feel free to, Dominic said, if you have any questions, even if I can't answer it, I will lead you in the right direction with the person that can answer it for you. And remember the golden rule. All right. Well, thank you.
Thank you for joining us today, Noemi. Yeah, so folks, feel free to jump out or jump off if you don't have any more questions. Okay, cool. Yep. All right, everybody's gone. Let me stop recording.